Thank you so much. So with that, ladies and gentlemen, we move to a final session that focuses on AI and analytics in market regulation, applications, challenges, and insights. Our speaker for the session, ladies and gentlemen, is Professor Partha Kanjilal, the co-founder and chief scientist at ResearchCare. He brings a deep experience in applying advanced analytics to regulatory environments where accuracy and accountability are non-negotiable. A former professor at IIT Kharagpur and visiting scientist at the Harvard Medical School, he pioneered neural network optimization and advanced genetics modeling. Please join me in welcoming, ladies and gentlemen, Professor Partha Kanjilal. And also with us, ladies and gentlemen, let's welcome with a round of applause Dr. Devrag Banerjee.
So one very personal note. So when I was a undergrad student in IIT Kharagpur, Professor Kanjilal was my thesis advisor, and we together wrote what was my first published neural network paper. And even to this day, after 30 years, it is my paper with the highest number of citations.
Thank you.
It's so glad to have you here today.
Thank you. Thank you very much.
Thank you.
Hello, everybody. Thank you very much. Uh, well, AI in market regulation is a very broad area. And this happens to be the last talk in this session. And I'm sure you folks are all saturated with inputs about AI. I will try to pass through the key glimpses of this interesting area. Okay, so what is the objective here? The key objective is that we protect investor interests and we provide market integrity. In US, as the SEC and FINRA are the two key organizations, two regulators that look after this space. And in India, we know that SEBI and RBI, these are the prime regulators looking after these these key objectives. Now, what are the regulators' jobs? They formulate and enforce rules, detect wrongdoings, discipline violators, broadly speaking. Now here, the interesting thing to note is that we are passing through a very interesting period in time. On one hand, we see phenomenal growth in the technology sector, and on the other hand, we see that India, now the fourth largest economy, and the fastest growing economy in the world. At the same time, that makes India a very lucrative place for fraudulent traders. Because with the advancement of technology and advancement of economy, obviously comes the burden of regulatory challenges. And our regulatory bodies are suddenly thrust with a lot of load of these regulatory challenges. Now, in terms of the increased load that we currently have, is that we can see that today, NSC is the third largest body in terms of the having to handle the cash equity sector, and in terms of the derivative sector, it is the body having the largest load of derivative trades. Now that itself shows that we have a tremendous amount of responsibility in handling violative efforts in the trading market. What is the obligation here? Now, anyone, whoever touches a trade, has the obligation to provide surveillance. That means whether it's a regulator, the exchange, or the broker-dealers, they all have to have their own surveillances running. And they have to establish and maintain and enforce trade and communication surveillances in all aspects of their handling of the trade. Let me now talk a little about market surveillance patterns. Well, what are patterns in general? I know that we have talked a lot about various aspects of modeling. Let me just say, in a very simplistic way, those who are new to this space. Now, suppose you have gone to a place where there are many birds, and you are asked to identify ducks. How do you do that? Well, you say that if it looks like a duck, if it walks like a duck, and if it quacks like a duck, then most probably it is a duck. So similarly, in the trading sector, when we are getting billions of trades coming or passing through our exchanges, it is the job of the analytics folks to look at the various aspects of these trades, look at the various features that constitute that trade, and from that, they have to identify the specifics that relate to a violative trade. Now, let me go over a very simple example of a market surveillance pattern, a wash trade pattern. Now, wash trade, what is the purpose here? The fraudulent trader is trying to give the market an impression of large volume. How does it do that? Well, they buy and sell the same stock, more or less at the same price, more or less at the same volume at the same time. So, for example, here we see 6 rows of data, and that basically are 6 different trades, and they are coming in pairs, buy and sell, more or less the same volume, same price, and same time. There may be some differences, but overall, there is no meaningful change in the ownership. We call it the beneficial ownership of the stock. Okay? So no economic substance in this activity. So this is a fraudulent activity. And to capture this, we will like to have a model. And how do we build a model for this? So we first identify the features. So say we can take 4 basic features here: the washed quantity, the difference in the quantity, the difference in the price, and the difference in the time. Okay. And so broadly speaking, we have first the features identified, then we put the weights for the features, and based on this, we find out the total score for the feature. Now, each feature is assigned a particular score, and then you compute the total score. Now, in real life, the problem is that in most cases, the vendor models and the models that are designed in-house, they are not scored. So if the models are not scored, the exceptions is very difficult to dig through the large number of exceptions to find out which ones are really violative and which ones are really deserve your attention. So the ground truth here is that all the exceptions that are captured by the exchanges, individual firms, broker-dealers, most of them are never analyzed. So people just don't look at those exceptions. They don't have time. They don't have the resources for that. So how how is it that we see the enforcement actions? So basically, the enforcement actions are product from referrals. So someone is making money at the cost of someone losing money. So someone losing money complains to the exchange, and then exchange takes it up. And that's how the importance of the scoring lies. It is usually, if we are having a logic-based model, it may be that we won't have any scores. Usually, if you have a machine learning model, you have scores associated with the models. Let me look at another pattern, another simplistic pattern for scoring end-of-the-day trade. Why end-of-the-day trade? Well, this is end of the trade. That is the closing price on a particular day of a stock is very important because it can influence the valuation, it can influence the settlement, and the performance assessments of the portfolio is also dependent on that. If you can move the end of the price by 0.1%, that can make a few $1 million for some particular participant. So that's why end of the price is a very important component for the traders. So how can one manipulate this? Well, we are now capturing 4 different features in this particular case. One is a inverse square root function versus the time to close. So as you can see here, so the closer you are to the endpoint, which is on the left side, the higher the value of this particular feature. Okay. The second one is the time to end rank. Now, if your rank is higher, your score is higher. The third one is the percentage of market buy or sell volume. Now, this is a very important component. The more volume of the market you take at a particular time, over a period of time, the more influence you have on the price. So the percentage of market volume that you execute in the last second or last minute of the trade is very significant. And the fourth one is the market concentration. What does the market concentration mean? Suppose you are the only trader in the last minute of the trade. That means you have the 100% control over the closing price. So the market concentration is 1, very high. And suppose instead of 1, there are many participants. Then the percentage of market volume executed by individuals will be very small. And we use Herfindahl index, which is a summation of the square of the percentage market volume by the individuals. So with these 4 features, we can come up with a scoring of end of the day score for the particular participant. Now let us look at one real case of market manipulation. Now the story starts in 2023, January. Jane Street, a hedge fund, starts trading in India, and they start trading in a cross-product financial instrument. But by cross-product, what is meant is that you are dealing with 2 different type of asset classes. So in this particular case, they were trading with Bank Nifty ETF. Now, Bank Nifty ETF happens to be a bit vulnerable ETF in India because it has 2 or 3 components. I think 3 components which make up about 60 or 80% of the ETF. the rest of the theme of the constituent of the ETF is relatively very insignificant. So what Jane Street started doing is that they had basically three different steps in their manipulative strategy. First, they start buying the security, that is the stock, and the futures from around 9:15 to about 12 o'clock. Okay? And then you can see that and then they start the second part of the strategy, that is the short options, that is they sell calls and buy puts. Now, when an analyst is looking at this, every piece of this thing that you see here is of importance. You can see that the options trade is starting a little after the equity trade starts. Because why is so? What is happening is that after you start buying the equity, your equity price starts shooting up. As the equity price starts shooting up, the option price also will start shooting up. And you are wanting to sell the calls. That means you want someone to buy your calls. So as the option price starts shooting up, people will think that the option price will go higher and higher. So there is more interest in that product. Now here, what is going on is that in particularly Jane Street case, we are seeing that their buy volume is something like 4,370 crore. It's quite a large volume of equity and futures they're buying at a very aggressive rate. How are they doing that? Well, they are buying at higher than the market price just to push the price up. And they are taking an insanely large options position. 32,000 crores of options position in one part of the day, morning of the day. Now this snapshot that you see here belongs to January 17, 2024. They started in 2023. In the year 2023, they made $1 billion profit. Indian regulators didn't know about it. Okay. Now, 2024, the story looks like this. On this particular day, so they were lucky to make a profit of 735 crore in one day. So, as I was saying, first the stock price goes up in the morning half, and then after 12, they start selling the stock, again aggressively selling the stock on the futures. That means you are selling at a price lower than the market price to bring down the value of the security. As far as the options is concerned, is not touched, because you know that as the price drops, then the option value also shoots up. I mean, options short position shoots up. So, end of the day, the market price for the stock and the future crashes, and the options position explodes to a very high value. Overall, the net profit is 734.5 crores. Now, when you look at this, it's happening 1 year after they started doing this manipulative trade. You can see that straight away you can see some red flags. First of all, they are doing quite a large equity execution, more than 4,000 crores, okay, in 1/2 of the day, and taking 20% of the market. That means they have quite a large control on the price of that security at that point in time. Okay? Now they're taking an insanely large options position. Now usually options position is taken for hedging purposes. Now hedge means the notional value of the underlying, in this particular case, stock and futures, and the notional price of the derivative, which is the options here, sort of should be comparable. Now here you see that the options price is 7 times. That itself is another red flag. And the third thing is the net profit. Now if in this industry, if you don't have any data, only if you have the profit, if you know the profit that a person is making every day, that itself conveys a lot of information. And if you can track the profit over a period of time, you can easily see a spike. On a particular day, there is a spike. Something is going wrong, right? Now, obviously, one can say that the SEBI was caught napping on the wheel, but no one can say that, well, we don't have a pattern. We don't have a pattern that captures this particular behavior. How do we know? Well, the fraudulent trader knows what patterns are normally used by the regulators. So they will not use the same pattern, not necessarily. So they'll be always tweaking the pattern. And when we're talking about a profit of 735 crore, we have to understand it's a zero-sum game. Someone is losing money. Someone is bleeding. And this is a silent war that goes on in the securities industry. Okay? And there are no problems. They have been doing it for the last 1 year, and they continue to do that until, by the sheer chance of luck that for the regulators, then that in April 2024, there was a legal battle that Jane Street got into with another hedge fund, Millennium, because the Millennium tried to poach these two folks who were doing this very profitable trade in India. And the judge was curious to know what was that very profitable trade in India. So they had to open up. And then the whole world came to know, and then SEBI also came to know. So what we learn from this, that, let me skip this in the interest of time. So basically what we're saying is that violative trades may be unique in nature, and you cannot expect that this will be captured by the type of surveillances normally run. But we have a responsibility to ensure market integrity. And when we are saying that India is 4th largest economy in the world, and we have the fastest growing economy in the world, with that comes a certain degree of responsibility to have a market with some sort of integrity. And there is no excuse, like we cannot say that we don't have this pattern. We've never seen this before. So there has to be some, basic infrastructure, regulatory infrastructure that helps us detect any violative or abusive behavior of the traders. And this particular case, if we look at the percentage market volume taken, if we look at the fact that the securities being handled are such that one can be used to manipulate the other, that itself is a red flag. If you can, in addition to that, if you have something like a client analytics, like you have in KYC, normally we don't have in regulatory industry. If we know the history of the participants, what normally which securities they execute, what sort of volumes they do, what sort of percentage of the market they do, then that also could be another infrastructural help that the regulatory industries can have. So these are the different components that have to be built in addition to the conventional surveillance patterns. So then it becomes easier or I would say that then the chances of capturing a violative trade is higher in such circumstances. There are other advantages, other components that are of interest. Obviously, data, we all know that particularly in US, they have a consolidated audit trail, they call it CAT, which is handled by FINRA, which has a complete history of each order and the execution. And that sort of thing is missing in here. But if we can do whatever we have to corral all the information that we have and then collect the information together, we can see some pattern emerging from that. And this is one thing that is important to note, that today, when we are saying that the technology is going ahead, the economy is surging and all that, we have to have minimum degree of coverage where the gaps lie in our regulatory system. For that, we don't necessarily have to have a very sophisticated guardrail. Even if we have some guardrail, some anomaly detection, some basic components, then we can at least have some red flags which can help us identify issues like this. So with that, I will wrap up. It's almost time. And this is the attitude of the folks who do violative trades. Thank you.
Thank you, Professor Kanjilal. Let's have a round of applause for him. Ladies and gentlemen, the clear and insightful session, that was wonderful. Your perspective on applying AI and analytics in the regulated markets environment is highly valuable. Thank you so much. And to present the token of appreciation, I take this opportunity and invite on the stage the Head Treasury for L&T Finance. Put your hands together for Mr. Ravindra Gerasappa. Welcome, sir. We all can have a round of applause for the final session, ladies and gentlemen, by Professor Kanjilal.
Thank you.
Thank you so much, sir.
Thank you.
So, ladies and gentlemen, as we close today,